Welcome to Money Matter, your source for financial insights. If you've ever made a payment using your phone, transferred funds through an app, or checked your bank balance online, you're already involved in a multi-billion-dollar industry. This industry is known as Fintech, and it's transforming global economies. Fintech is short for financial technology. It may sound straightforward, but the term encompasses a vast array of products, technologies, and business models that are reshaping the financial services sector. Fintech covers everything from cashless transactions and crowdfunding platforms to robo-advisors and digital currencies. Each time you contribute to a Kickstarter campaign, that's Fintech. Similarly, when you use Venmo to send money, you're participating in the Fintech world, and that's just the beginning. At a major Fintech conference in Amsterdam, hundreds of companies are striving to revolutionize banking and finance by altering the ways we pay and borrow money. Investors are enthusiastic about these changes. Since 2010, global investment in the fintech industry has reached nearly $100 billion. In 2017 alone, fintech investment increased by 18%. Most of this funding went to startups focusing on payment and lending technologies. But it's not just startups. Major corporations like Apple and Alibaba are heavily investing in fintech too. Just think about Apple Pay and Alipay. Why all this investment? Because consumers are rapidly adopting fintech solutions. In 20 major economies, 1 in 3 people reported using at least 2 fintech services in the past 6 months. China and India are leading the charge, with over half of their consumers utilizing services such as money transfers, financial planning, loans, and insurance. Financial technology has bridged a gap for people worldwide who lack access to traditional banking services. Approximately 2 billion people globally are unbanked, but fintech has changed that. Now, all you need is a phone to secure a loan or insurance. Take Kenya, for instance, which pioneered a mobile banking system called M-Pesa. Kenyans use M-Pesa on their mobile phones to transfer money, pay bills, or take out loans. Today, about 96% of Kenyan households use M-Pesa, and one study found it has helped lift roughly 2% of households out of extreme poverty. The rise of fintech has compelled traditional lenders, insurers, and asset managers to adopt new digital technologies. For example, wealth managers now compete with robo-advisors, which are automated financial planning services. These high-tech algorithms offer 24/7 services and can be more cost-effective than traditional asset managers, explaining why robo-advisors already manage billions of dollars. Like any growing industry, fintech comes with risks. Some regulators are struggling to keep pace with rapid innovation. Consider peer-to-peer lending platforms, where individuals can lend and borrow without a bank. These services might not be required to set aside as much capital as traditional banks in case of loan defaults, posing risks to both companies and consumers. Data privacy is another significant concern, as increased digital financial services heighten the risk of cyber attacks. The challenges facing fintech will likely expand as more businesses go digital. But for many companies and consumers, fintech represents more than just a buzzword. It's a significant business opportunity.